If your Dow Jones read feels safe here, that comfort might be the most expensive thing on your screen. By the end, you will know which level tells the truth.
The Dow Jones is flashing a warning, down slightly over the past 3 trading sessions, as market participants rotate away from the industrial base. Today's hypothesis is that the blue chip average is losing its resilience as inflation uncertainty forces a major reassessment of valuation. We are going to test this structure through the Dow as our subject, the US dollar index as our driver, the S&P 500 as our context, and gold as our final confirmation. This is an observation lab, not a fortune teller. Our job is to read the current tape before the inflation print drops. Jake, how are you reading this industrial softness?
The momentum is clearly shifting, and the industrial giants are feeling the heat while the tech side tries to decouple. What you need to realize is that the bid under the Dow was predicated on a very specific soft landing story that the inflation data might be about to dismantle. This is not just a quiet pre-data drift, it is a structural repositioning by institutional desks that are seeing the risk-reward skew turn negative.
Wait, Jake, let's not get ahead of the evidence. The Dow is sitting at an alarming level, but it has not broken the primary structural support we have been tracking for weeks. The narrative is screaming vulnerability, yet the tape shows we are still within a defined range that has absorbed every shock this month. What decides the setup is whether the industrials find a cash bid before the Bureau of Labor Statistics release on Wednesday.
Before we open the charts, what do you think is really driving this, the industrial rotation, or the broader dollar strength? Type whichever one you would back in the comments, I read every reply. Looking at the news, we have Germany confirming an inflation acceleration to 2.8% and India's retail print hitting 4.45%. These are global signals of a sticky pricing environment that is making the US dollar index very difficult to ignore as a headwind. Let's get into today's hypothesis before the tape moves again and see what the subject chart is telling us. Now the Dow Jones, the star of today's vulnerability read. We are looking at the Ichimoku cloud, which is like a multi-layered structural indicator for price action. Right now, price is sitting above the cloud roof, which serves as our primary support floor, and the baseline is anchored just below current levels. Jake, the Harami candle pattern yesterday suggests we are in a tight compression phase.
Exactly, that Harami pattern indicates the prior selling pressure is pausing, but it does not mean the bid has returned. The volatility range is widening, which tells us that the market is preparing for a volatility expansion, and price is currently hovering in the upper half of the envelope. It looks like it is waiting for a reason to either snap back to the mean or accelerate higher.
But look at the Relative Strength Index, or RSI. It is basically a speed gauge for the trend, and right now it is stalling near the 60 level. It is not showing the kind of aggressive strength you would need to confirm a real recovery from the recent hit of about 176 points over the past 3 trading sessions. If that baseline in the high 53,000 range fails to hold, the floor gets very thin very quickly.
I see that, but the conversion line is still stacked above the baseline, which usually signals that the short-term trend has some gas left. We have not seen a bearish crossover yet, which means the industrial bulls are still trying to defend this psychological zone.
The Dow Jones currently sits near a critical checkpoint, but the technical structure remains unresolved. This strengthens our hypothesis that the market is in a wait-and-see mode, as of the latest reading, where any deviation in the inflation data will force a structural break. Now let's look at the driver forcing this pressure. The US dollar index is our driver today, and it is currently trading inside the Ichimoku cloud. When price is inside the cloud, think of it as a low visibility zone where no clear trend is established. However, we have a bullish lower shadow candle that suggests institutional buyers are stepping in every time we test the cloud floor.
The dollar index is showing real grit, and that is what is pressuring the industrials. The volatility range is expanding here as well, and we are seeing the price press higher within that range. It is basically a volatility expansion zone where the greenback is sucking liquidity out of risk assets.
The RSI is still quite neutral, sitting in the low 40s, which suggests there is no overbought condition yet. If the dollar index clears the cloud roof in the high 99 handle, it confirms a total regime shift that the Dow is simply not priced for. The lack of a bearish reversal in the RSI while price stays in the cloud is a warning sign that the dollar strength has legs.
The dollar's presence inside the technical structure confirms that the driver is in a state of high tension. This reinforces our read that the Dow Jones is being squeezed by a currency that is refusing to weaken ahead of the CPI print. For context, the S&P 500 is still holding well above its cloud roof, showing much more resilience than our industrial subject. The conversion line and baseline have completed a bullish crossover, and the gap between price and the cloud is over 4%. This suggests the broader tape is still trying to fight the risk-off narrative.
The S&P 500 is the engine of the tape right now, but the Harami pattern here matches the Dow, showing a universal pause. The volatility range is widening, and we are near the upper edge of that volatility range, which usually means the market is stretched relative to its recent volatility.
Here is the problem. The RSI on the S&P is showing a bearish divergence, where price is trying to hold its ground but momentum is actually fading. That is a historic signal that the current rally is getting tired. If the broader market context starts to leak, the Dow Jones does not have the technical cushion to survive a systemic sell-off.
As of the latest reading, the S&P 500 provides a layer of defense for our hypothesis, but the momentum divergence confirms that the industrial vulnerability is a warning for the entire complex. Let's finish with our confirmation asset. Gold is our final confirmation, and it is staging a bullish band walk, where price stays pinned to the upper Bollinger rail. This is a sign of extreme institutional demand. It cleared the recent technical boundary and has been using it as a launchpad. Ava, how does this fit your risk view?
This is the hedging signal I have been looking for. Institutional managers are piling into the yellow metal because they do not trust the equity floor. The support zone beneath gold is broad, but that cushion still needs follow-through to confirm durable demand.
But look at the RSI, it is nearly 70, which is entering the overbought zone. Usually, when the speed gauge hits that level, you expect a cooling-off period. If gold rejects this upper band, it might signal that the inflation hedging has reached its short-term limit, which would give the Dow a temporary relief valve.
Gold strength confirms that the market is hedging for an inflation surprise. This validates our hypothesis that the Dow Jones is under structural pressure from a rotation into safety. Now to the mechanism behind this move. The mechanism driving this industrial rotation is a classic repricing of valuation resilience. When we see the US dollar index strengthening alongside rising 10-year Treasury yields, it creates a dual pressure environment for the companies in the Dow Jones. Industrials carry higher debt sensitivity and are exposed to global growth headwinds through a stronger currency. We are not predicting tomorrow's market, we are measuring today's air, and right now, the air is getting thinner for the blue chip average.
It is all about the discount rate. If the inflation data on Wednesday comes in sticky, the Fed has no choice but to stay restrictive. That is the main enemy for the Dow right now. High rates for longer destroy the valuation floor for these mature companies that rely on steady credit conditions. We have seen this before, particularly during the mid-cycle inflation scares of the late 1970s, where the industrials lagged while commodities caught the bid. This tape is echoing that regime shift.
The hidden assumption everyone is making is that the consumer can continue to absorb these higher prices. Look at the India inflation print we mentioned earlier. Food prices are accelerating, and that is a global drain on discretionary spending. If us consumers pull back, the industrials are the first ones to see their order book shrink. The structure we are watching is incredibly fragile because it depends on the Fed having the room to cut, and the current data is taking that room away.
The hypothesis holds as long as gold and the US dollar index stay firm. If we see a breakdown in the dollar alongside a failure of gold to hold its recent gains, it would invalidate this rotation red. The next structural check is whether the Dow can maintain its position above its Ichimoku baseline. Without that anchor, the structural cascade has no obvious circuit breaker until we hit the swing lows from earlier this summer. This is the setup into the inflation print. Dow Jones ranks first on the completed 3-session comparison. It currently stands at 53,856.9, down 0.33% over the past 3 trading sessions. That ranking describes the completed comparison window and is not a forecast for the next session.
US dollar index ranks second on the completed 3-session comparison. It currently stands at 99.878, up 0.26% over the past 3 trading sessions. That ranking describes the completed comparison window and is not a forecast for the next session.
S&P 500 ranks third on the completed 3-session comparison. It currently stands at 7,745.6, down 0.07% over the past 3 trading sessions. That ranking describes the completed comparison window and is not a forecast for the next session.
Gold ranks fourth on the completed 3-session comparison. It currently stands at 4,414.1, up 1.68% over the past 3 trading sessions. That ranking describes the completed comparison window and is not a forecast for the next session. Read the board as a cross-asset comparison. Leadership, breadth, and confirmation matter more than any isolated print. The next update will test whether this ordering persists, narrows, or reverses. Tomorrow's focus is entirely on the U.S. Bureau of Labor Statistics inflation report. Watch the headline CPI release at 12:30 p.m. Universal Time. That print is the final arbiter for today's hypothesis. If the number is hotter than consensus, the pressure on the industrial base will likely intensify, while a cooler print could trigger a violent short-covering rally in the Dow Jones. We are also monitoring the 10-year Treasury auction at 5 p.m., which will decide if the bond market confirms the inflation read.
The momentum depends on those 2 events. If the CPI is sticky, the dollar bid will likely accelerate, and we will see the industrials lose the floor entirely. But if the yield curve starts to soften, the tech side might try to lead a relief bounce that leaves the Dow behind.
The real question is whether the Dow Jones can hold the support level at 53,377.8 when the data prints. That is the key support for the industrial bulls. Below that zone, the deleveraging has no institutional floor until we see the cloud floor on the daily chart. The answer to that single question reroutes the structure for the rest of the week. That wraps today's market map. Keep the forward watch on your radar for the next session. Subscribe so the next session lands first thing in your feed, and like if today's structure helped you.